Good morning, and welcome to Great Western Bancorp's first quarter fiscal year 2020 earnings conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star, then 1 on your telephone keypad. To withdraw your question, please press star, then 2. Please limit yourself to one question to allow other callers an opportunity to ask questions. Joining the call this morning are Ken Karels, Chairperson, President, and Chief Executive Officer; Doug Bass, Chief Operating Officer; Peter Chapman, Chief Financial Officer; Carlin Canarium, Chief Risk Officer; and Seth Arts, Head of Investor Relations. Before getting started, Great Western would like to remind you that today's presentation may contain forward-looking statements that are subject to certain risks and uncertainties that could cause the company's actual future results to materially differ from those discussed. Please refer to the forward-looking statement disclosures contained in the presentation on the company's website, as well as their periodic SEC filings for a full discussion of the company's risk factors. Additionally, today's certain non-GAAP financial measures will be discussed on this conference call. References to non-GAAP measures are only provided to assist you in understanding Great Western's results and performance trends and should not be relied upon as a financial measure of actual results. Reconciliations for such non-GAAP measures are appropriately referenced and included within the presentation. Please note this event is being recorded. I would now like to turn the conference over to Great Western Bancorp's Chairperson, President, and Chief Executive Officer, Ken Karels. Ken, please go ahead.
Okay, good morning, and thank you for joining the call. With this quarter marking the beginning of our fiscal year, I'd like to point out a few highlights. Net income of $43 million has remained very solid. We were successful in our strategic management of deposit interest cost, which decreased in the quarter by 20 basis points, and we will continue to manage this going forward. Strong expense control resulted in an efficiency ratio at 46.2% for the quarter. None of our share buyback authorization was executed during the quarter, but we will continue to look at this as we generate capital in excess of what is required to fund organic growth due to our strong returns. Now, for more insight on our financial results, I'd like to turn the call over to our Chief Financial Officer, Peter Chapman. Pete.
Thank you, Ken, and good morning, everybody. Looking firstly to revenue, interest income was $132 million for the quarter, which decreased because of a $2 million reversal of interest on exposures that were moved to non-accrual during the quarter, and also a decline in lending balances, which Doug will touch upon more in a minute for everybody. Our net interest margin and our adjusted net interest margin were 3.68% and 3.65% respectively for the quarter, with the adjusted net interest margin down 4 basis points quarter over quarter, with a 7 basis point impact from the interest reversal on loans moved to non-accrual. In addition, a reduction in loan yields lowered NIM by 17 basis points, but this was offset by a reduction in total deposit costs of 20 basis points and a slight improvement in the investment portfolio yield of 2 basis points. We'll continue to proactively manage deposit costs and mood rates again down in January, but expect underlying NIM to contract a few basis points per quarter in the current rate environment in line with prior guidance, particularly as we're seeing loan yields continue to compress as competition for good credit relationships remains very strong. Non-interest income increased by $0.7 million for the quarter to $15.7 million, mainly due to an increase in wealth management income through the closing of the Colorado acquisition at the start of the current quarter. Non-interest expenses were $57 million for the quarter, an increase of $1.7 million. Salaries and benefits increased by $2.8 million due to lower variable compensation in the prior quarter, in addition to general salary expense increases and stock vestings in the current quarter. Also, professional fees increased by $0.4 million due to lower FDIC expense in the prior quarter. These were offset with reductions in data processing and communication expenses by $0.8 million due to lower customer mailings in the current quarter and higher annual maintenance expenses in the prior quarter. While we continue to be diligent with our expenses, we expect an increase in the following quarters due to annual salary merit increases effective in the March quarter, investment in new lending resources to grow the business, and credit and risk management investment to continue to enhance management, monitoring and analytics of the loan portfolio. Accordingly, we expect spend to be more in the $59 to $60 million range going forward. For more now on loan and deposit growth, I'll turn the call over to our Chief Operating Officer, Doug Bass. Over to you, Doug.
Thanks, Pete, and good morning, everyone. At the end of the December 19 quarter end, loans were $9.6 billion, which is a decline of $81 million from the prior quarter. During the quarter, commercial real estate loans decreased slightly as advances in construction and development and multifamily residential were offset with declines in non-owner occupied and owner occupied. During the quarter, we experienced $106.5 million in credits that refinanced with other financial institutions at pricing that did not meet our return targets. Commercial non-real estate loans were down $43.5 million. This was mostly centered in our mortgage warehouse portfolio that ended the quarter down by $26 million due to the underlying transaction and disbursement activity. Additionally, the undrawn percentage of operating lines of credit increased approximately 1% over the last 2 quarters. This reflects a balance decline of approximately $25 million. Agricultural balances decreased $28 million during the quarter, with the decrease primarily driven by the exit of relationships with a higher risk profile, which is a trend we anticipate over the upcoming quarters as operators secure suitable financing alternatives. Our de novo office strategy continues to be a key contributor to our growth and expansion, and for the quarter, the aggregate growth of those portfolios were 4% annualized. We have successfully opened 11 offices over the last few years, 3 of which are currently in the loan production office stage. Currently, we have leadership and teams in place for 2 new locations, with timing dependent on reaching internal targets. 9 new commercial bankers have been hired in various existing markets during quarter fiscal 1. Consistent with prior guidance, we will spend fiscal year 2020 rebalancing the risk profile in all sectors of our loan book, particularly those in the agricultural sector. Our priority of improving asset quality is expected to result in exits that will impede loan growth, which we have seen traces of already. This will continue over the next few quarters, and our expectation is still for loan growth to be in the low single-digit range for 2020. Deposits declined $212 million to $10.1 billion during the quarter, primarily related to a reduction in brokered deposits of $214.8 million, as those costs have become less competitive. Within the rest of the portfolio, non-interest-bearing deposits showed good growth, particularly in the consumer book, offset with a $127 million decrease in non-brokered time deposits. Management of deposit costs have resulted in a 20 basis point decrease during the quarter due to the increased mix of non-interest bearing coupled with a decrease of 25 basis points in interest bearing costs from reduced rates on money market and offering rates on time deposits. We have moved deposit rates down again in January and will continue to move our rates down commensurate with declining loan rates to maintain a targeted net interest margin. I'll now turn the call over to our Chief Risk Officer, Karels, who also oversees our loan review function, to provide updates on our asset quality strategy. Karels?
Thanks, Doug. For the quarter, net charge-offs of $6.1 million were 25 basis points on an annualized basis, which is a decline from 31 basis points in the prior quarter. Of this amount, $4.5 million was attributable to a few ag relationships, with the remaining $1.6 million spread across a number of smaller non-ag relationships. Total credit-related charges at $12.6 million were $8.4 million higher than the prior quarter, driven mainly by $6.1 million of more normalized provision expenses and $2 million from reversed interest income on loans moved to non-accrual in the period. Non-accrual loans as a percent of total loans were 1.62%, up from 1.1% the prior quarter, and a modest increase from historic levels, primarily related to a small number of agricultural loans identified as we continue to work through the higher risk credits. Our allowance for loan loss to loans increased 3 basis points in the quarter to 76 basis points, and our comprehensive credit coverage, which includes credit-related fair value adjustments on our long-term portfolio and purchased accounting marks, was 94 basis points. Looking at our loan classifications, our loans rated substandard increased $168 million to $640 million due to a $67 million net increase related to a small number of ag loans, primarily in dairy and one in the swine sector, and a $101 million increase in non-ag loans, particularly with a few relationships in health services. Watch loans increased slightly to $416 million related to additional monitoring of a small number of relationships. As an update to the asset quality of the dairy portfolio, at the end of the quarter, we had $230 million rated as substandard and $63 million rated as watch. Fundamentals for the sector continued to improve, and in general, Quarter 2 and Quarter 3 financials validated the anticipated improvement in profitability supported by a lift in milk prices. We are regularly gathering financial information as it becomes available so we can update our views on not only the operational performance but also the overall financial health of each relationship. In recent quarters, we have discussed our broader focus on overall asset quality, and we are making good progress on those initiatives. One key change we will make relates to loan classifications and ratings, as we have an in-flight project that will give a more granular view of our loan ratings and asset quality in general in coming quarters. Among other things will be the implementation of a special mention rating category as part of a criticized loan framework that does not exist in our current rating scale, but typically is used by other institutions and falls between watch and substandard. By implementing our new scale, we will better align with the criticized and classified ratings and metrics seen in the industry, while also allowing us to be more efficient in managing our credits and relationships and complementing our adoption of CECL later in the year. While this project is not yet complete, all things being equal, we would expect this to move a number of relationships from substandard to special mention when implemented and bring down the level of substandard loans based on the current portfolio. With that, let's turn the call back to Ken for some closing remarks.
Okay, thank you, Carlin. I am pleased with how we've begun the year, as our consistency in expense and margin management resulted in good earnings, reflected in our strong return on tangible common equity of 15% and return on assets of over 1.3%. Now is the right time to reposition our loan portfolio and make enhancement that will both improve our current asset quality and enable us to achieve future growth. We will now open up the call for questions.
We will now begin the question and answer session. To ask a question, you may press star and then 1 on your telephone keypad. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then 2. Please limit yourself to one question to allow other callers an opportunity to ask questions. The first question today comes from Jeff Rulis with D.A. Davidson. Please go ahead.
Good morning.
Good morning, Jeff.
Yeah, really just a credit-related question. On the commentary on the dairy side, so if that was sort of the impetus for the increase in substandard loans, could you true that up with the commentary on how you're feeling more positive on dairy, kind of what's flushing through there, and maybe if you could touch on kind of workout timelines of what was added, and then kind of into the renewal points of do we expect to see when the dairy book is then annual reviewed, kind of the exit point of that. That'd be helpful. Thanks.
Okay, Jeff, this is Doug. Let me take that question for you. First off, on the substandard increase, it was due to a one-time event that should be corrected on that relationship in the month of February. It was not an earnings or cash flow related downgrade. That item should be corrected here. Relative to comments I think that were made last quarter, we talked about roughly a 155 cash flow with Class 3 milk prices in the low 16s. What we are seeing today would be debt service coverage from that up to 2.0 times for debt coverage, and that's reflected in Class 3 milk prices that are averaging in the low 17s today. Probably also to note is many of the producers are using the opportunity to lock in revenue insurance through the USDA program, which allows them to lock in current prices out for 18 months. Many of our producers are using that program. Relative to renewal timelines and risk rating timelines, we have looked at these credits on a rolling 4-quarter basis. Many of the operations started turning the quarter in in Q2. Virtually all had very profitable results in Q3 as we're gathering information. Q4 results for fiscal year end 12/31/19 will usually start coming in toward the end of March, April, and early May. So the renewal season for this book of business would typically be in the April-May timeframe. We anticipate, based on trends of the last 2 quarters and recent milk prices and locked-in prices through the Revenue Protection Program and favorable production levels, that a number of these relationships will be considered for risk rating improvements at the renewal period. It'll probably be in the April through May timeframe.
Doug, what was the size of the one-time ad that you expect to be corrected in February?
Well, the substandard credit result from 9/30 to September went up $35 million, so it was embedded within that number.
Okay, and I'm sorry, the last one was just on charge-off visibility. This was sort of the lowest quarter, I guess, on net in the last few quarters. Fiscal 19 was obviously a bigger charge-off quarter. Any visibility on fiscal 20 charge-off activity, something less than 19 and something more than 18? Any broad thoughts on where we are in the cycle on charge-offs?
Just Jeff Ford, I suppose. If you look over the average of the last 4, that June one we'd hope is an anomaly in there. So look, I think somewhere in that 25 to 30, 25 to 35 point range, I think is a safe boundary to think about it in.
Thank you.
Okay, thanks, Jeff.
The next question comes from Andrew Liesch with Piper Sandler. Please go ahead.
Hey guys, good morning.
Morning, Andrew.
Just want to touch on the securities book in the quarter, and then the increase in borrowings. Just kind of curious, what was really driving some of the movement there? Was the addition of borrowing just to offset some of the deposit outflows in the brokered accounts? Then what was causing the build in the securities book, and how should we look at that as a size going forward?
Yeah, sure. It was a sort of a mixed change, Andrew, between the brokered CDs and FHLB. We just look at both of those interchangeably, and whatever's if we can save a few points going one way or the other, we'll certainly continue to look to do it. There's a little bit more build in the current quarter. We had some good deposit inflow. I'd see it sort of flattish to a modest sort of low single-digit increase for the rest of the year, Andrew.
Okay, great. Thank you. I'll step back.
Great, thank you.
The next question comes from Ebrahim Poonawala with Bank of America Merrill Lynch. Please go ahead.
Good morning, guys.
Good morning.
Hey, Ebrahim.
I guess this is the first question. Taking a step back on credit, it sounds like you don't expect, just Pete, the charge-off guidance you gave for the year doesn't sound like you expect big losses despite the migration that we've seen. So the P&L impact when we think about provisioning should be relatively modest as you move some of these credits through. Is that a safe assumption?
Look, I think sort of run rate on where we are in the current quarter, Ibrahim, is maybe a couple of $1 million above what we've previously guided once you sort of throw the interest accrual in there as well. But we'd hope sort of a quarter like this looks to be a more normalized quarter from an overall expense perspective. There could be a little bit of lumpiness quarter on quarter as we do go through some of these larger ones with charge-offs and the like, but sort of over a 3 or 4 quarter cycle, we'd hope it settles down to around these levels.
And I guess the bigger picture, just because of all the moving pieces on ag portfolio, and you talked about higher risk portfolio a few times, can you quantify what you view as higher risk of your total loan book? And you've talked about some runoff, which is included in your low single-digit loan growth guidance. But I'm just trying to get a sense of what do we expect on substandard loans, on watch list loans as we move forward in 2020? Do we continue to see inflows, or do we start seeing an improvement? Because that's kind of the biggest driver of how, from an investor standpoint, folks are looking at your stock. And I'm just trying to get a sense of, should we prepare to see worsening in those metrics or an improvement?
Yeah, Abraham, this is Doug. Let me talk versus maybe into the next quarter or the following, let me talk over a several quarter horizon. When we look at, the trajectory, as I mentioned earlier, of the dairy book, we see a number of upgrades that are happening there over the next 2 fiscal quarters. And then when we take a look at a couple of the other large downgrades that happened in the hog industry that we called out in the PowerPoint that you've seen, those 2 operations have also seen more favorable results as tariff impacts early in calendar 19, so we see some rebounding there. Grain prices for much of the Midwest are at break-even levels when we look at corn and soybeans, cattle and hogs, and again, more of the operations are probably going to show positive results. So it's really difficult to project a quarter-to-quarter number, but over the horizon of the next few quarters, we plan to see improvements in those metrics.
Got it. And anything outside of the ag book where you're concerned? So you mentioned some of these C&I loans where you've seen one-off migration issues. Anything that's concerning from a geography standpoint or an asset class? You mentioned healthcare earlier. So just wondering if there's something there that could become an issue.
Good morning, this is Carlin. We are conducting monthly segment reviews as part of our risk management practices, and we just recently did conduct a healthcare deep dive, actually, and did not downgrade any pass-rated credits from that review. And as far as other emerging areas, we think that at this point we've been through the majority of our higher risk portfolios and are now migrating down to smaller credits for further review. Geography, nothing is really sticking out that way.
Got it. And just on a separate topic, if I can sneak one more in terms of capital return, you mentioned in your strategic priorities for the year looking at acquisitions. Ken, if you can just talk to us in terms of buybacks versus M&A, how you're thinking about both those, and if there's any update on the CEO search.
Yeah. I think you got 3 questions in there, Abraham. That was really good. So first, definitely we will continue to look at acquisitions, and without going into much detail, always have something active on it too. There's some opportunities maybe for some deposit-only acquisitions that may happen. And we still have strong returns, generate a lot of capital. We, as other banks, are seeing lower loan growth. And so we will be looking at doing stock buybacks here at the opportunist times. That will continue. Both of those, I think, can be done with the capital that we generate on it, too. On the CEO search, the board is very involved and quite far along with the CEO search. Without going into too much detail, obviously the board will have to make some final decisions, but we would hope to have an announcement here in the next few months regarding the CEO succession on it, too. So that is moving, very, very fast and appropriate.
Got it. Thanks for taking my questions.
Thanks.
The next question comes from Jon Arfstrom with RBC Capital Markets. Please go ahead.
Thanks. Good morning.
Good morning.
Couple follow-ups. Just bigger picture on ag again. Just based on your comments, Doug, I don't want to put words in your mouth, but I think you're saying that your ag portfolio is stabilizing to potentially improving. Is that fair?
Yeah, I think that's a fair comment, John. I mean, from one quarter to the next, we're gathering a lot of 12/31 information here over the next few months, so the reflection and improvements will probably be over the next couple quarters in that result. But yes, I think, commodity prices in dairy have improved, and we've seen that in the last half of 19 results, and we chart by monthly milk checks, and we can see that result in the fourth quarter continuing to move up.
Okay. And then, as long as you have the mic, some of the loan growth activity, you rattled through a few items, and I think you said $106 million in payoffs, another $26 million in warehouse, $28 million in ag. You talk about the offset to that. Where are you seeing the growth potential that offsets, some of those headwinds?
I think first off on the warehouse lending piece, the $26 million, that was really a seasonal piece. All those relationships are still here, and balances have already, starting to come back, although there's obviously seasonality to it in the spring as it picks up. That is also a segment that we're seeing increased opportunity and demand in, and we feel very comfortable with the risk profile of our warehouse lending book. That's a segment we'll continue to see increases in. We also will continue to see some headwinds, as I mentioned, on the ag side, as we look to find alternative financing options for some of the higher profile risk credits. On the opportunity side, we talked about the new markets. We have a 4% annualized growth going. We've got 2 new ones we're looking at. We also have a couple others that are in the infancy stages that are probably latter in 2020 and 21 that are being discussed. So a number of initiatives internally to take a look at to try to augment and offset the headwinds of some ag portfolio declines, which have been over the last few quarters.
Okay. All right. Thanks for the help.
Thanks, John.
The next question comes from David Long with Raymond James. Please go ahead.
Good morning, everyone.
Good morning.
The substandard loans that were in the non-ag, I think you said it was the healthcare services related. Any additional color you can provide on those? Were there anything in common amongst the credits that we should be aware of?
I think as Carlin mentioned, David, nothing geography that would be consistent. What we are seeing are senior housing projects that are in a slower absorption, slower lease-up than originally planned, and when those don't meet original assumptions, we move them down in a risk rating mode. The fortunate piece is all of those have been supported by guarantor and ownership and continue to see improved performance. But it's really just in that healthcare piece, and then as Carlin mentioned, we went through the segment report in January, given the elevated downgrades in that sector, and resulted in feeling good about the entire rest of the book with no further downgrades.
Got it. Good. Thank you. And then as it relates to your deposit costs, very good quarter there. If everything kind of moves as you planned, what kind of improvement in deposit costs can we look at for the next couple of quarters?
Look, probably a little bit more modest than what you've seen this quarter, but as we said, we've moved money market and CD rates down in January to sort of move towards that inline guidance with NIM. So, the unknown is on the loan side of things, but we'd hope to manage NIM within sort of that few basis point downward movement over the next couple of quarters.
Okay, great. Thanks, guys.
Thank you.
The next question comes from Damon Del Monte with KBW. Please go ahead.
Hey, good morning, guys. First question, just wondering, Peter, could you give a little color on your outlook for fee income as we go into 2020?
Yes, certainly. I'd expect to see a more modest increase. Sort of, I think we usually typically talk low single-digit range in there. Damon, having the Colorado Trust acquisition come on board this quarter, that was nice to see income in line with what we thought that would do. So outside of that, I'd expect a modest increase. This next quarter is usually a little soft on that service charge line. Just seasonally, we find that service fee income's a little lower, and also you got a lower day count this quarter as well. That makes it a little lower.
Got it. Okay. And then with respect to land values for ag-based loans, what have been the trends on real estate values?
The Federal Reserve of Kansas City put out a report here recently that talked about a very modest 1% increase in the state of Iowa, and we had, sort of similar plus or minus 2 or 3% across. So I think, while certainly the ag economy continues to have its challenges, we've seen land values hold up relatively well, and there continue to be buyers, investors that are interested.
Okay.
Most sales come at private treaty as well, which I think is also an indication of the positive support.
Got it. Okay. All right. That's all that I had. Thank you.
Thank you.
Next question comes from Janet Lee with J.P. Morgan. Please go ahead.
Morning.
Good morning.
I want to go back to the healthcare services credit you pointed out as part of the increase in substandard loans this quarter. Just want to clarify, is this the same healthcare facility credit you called out last quarter in the watch loan category that has migrated into substandard loans? And can you quantify the size of this problem health credit you have on your book?
Janet, yes, it is. It's the one we mentioned that went into watch last quarter, and we put that into substandard. And that's correct. And, it's well within ranges of a lot of the portfolio, and, we don't probably get into quoting individual portfolio size of specific credits.
Okay, that's helpful. And on your comment last quarter, I think it was roughly around $318 million of total problem dairy credits, including substandard and watch loans. I think you mentioned about 30% of these were expected to be upgraded and about 20% of these going through self-liquidation. Can you just give us the update on the status?
Sure. I think if you look from September to December, the aggregate of watch and substandard went down about $25 million in the dairy book, and I think your percentages are continually be very close. We've made some estimates that are going to be right within those same ranges of combination of pay downs or upgrades that are roughly in the 40 to 50% of the current outstanding book. So we continue to see that improvement, and that's consistent.
Great. And lastly, just on loan growth, your low single-digit guidance, can you just talk about what are going to be the key drivers of the loan growth that are going to offset the decline in egg-related portfolio?
Sure. Well, I think we talked about the new offices. There's some other initiatives that we have implemented here over the last few months in a couple other sectors in our metro markets relative to some owner-occupied commercial real estate promotions that sort of tie into treasury management and operating lines of credit. We've also been working on some multifamily options and also some pieces that are in some of our larger markets in some specialty areas that we're considering as well. So primarily centered in commercial and C&I lending areas in our metro markets, Janet.
Great. Thanks for taking my questions.
Sure.
Thank you.
The next question comes from Terry McEvoy with Stephens. Please go ahead.
Thanks. Good morning. Just a couple questions on expenses. Last quarter, was there any impact in the expense line from the trust assets in Colorado? And then in the press release, you mentioned the recruiting expenses. Was that connected to the CEO search, or was that related to the build-out of the commercial lending teams that you've discussed in the past?
Yeah, more the going backwards, the recruiting expenses more on the CEO search. So definitely that was a factor there. And then on the expense side of things, there was the trust in there for the full quarter this quarter in there, Terry. And I think when we spoke about it last quarter, I think it was $300,000 to $400,000 in expenses. I said a quarter were embedded in there as a result of that acquisition.
Okay. And then just one last question, just on credit. You took the $26 million provision 3 quarters ago, and I'm just looking at substandard loans up, call it 35%. And what I'm hearing today is that reserve to loan ratio, which is relatively flat from when you took that larger provision. You still feel comfortable with that provision looking out over the next 4 quarters based on the improving trends in dairy, break-even in grain, and some of the other kind of positives you've run through as it relates to the health of your loan portfolio?
Yeah, this is Carlin. I would say that's correct. As I mentioned, we've conducted some pretty deep dives into many of these segments, and we feel comfortable with our provisioning at this point in time at the portfolio.
That's it. Thank you.
Thank you.
This concludes our question and answer session. It also concludes our conference. Thank you for attending today's presentation. You may now disconnect.